Okay, so right now, a lot of people are quietly thinking the same thing. Why does everything feel tight?
I don't even know. Like, I can't even tell you that. Like,
Bitcoin is down. Stocks are shaky. Groceries are still expensive. Rent hasn't dropped. Layoffs are creeping back up into the headlines. And even when the data says inflation is cooling, it doesn't feel like relief. So, what's actually going on? And why does the economy feel worse than the headlines? And are we heading into something bigger or is this normal? Yeah, there's a lot going on. What's up, everybody? I'm Zap Brath, musician and actor turned content creator, and I'm here to help you design a practical and personal money blueprint that provides a sustainable framework for achieving your financial goals. And you're going to want to stick with me to the end of this video because I'm going to show you what's actually causing this pressure in the economy, what could reverse it, and most importantly, what you should be doing with your money right now. But before we jump into it, as always, please do me a huge favor, hit that like button because that lets the almighty algorithm know that this is a cool video and more people should see it. All right, so why does everything feel tight? Well, for over a decade, money was cheap. Interest rates were near zero, borrowing was easy, stimulus checks were flowing. Remember those? Asset prices inflated, stocks went up, crypto exploded, real estate surged, and that wasn't normal. That was liquidity, and it was money flowing easily in the economic system. Then inflation hit hard, and central banks raised interest rates aggressively. And higher interest rates change everything. They make loans more expensive, they slow down business expansion, they reduce consumer spending, they lower stock valuations, they drain liquidity from crypto, so interest rates are a big thing. Oh! And right now, money is restrictive, and restrictive money makes everything feel heavy. But one thing you can do that doesn't feel heavy is hit that subscribe button, because if you made it this far into the video, then you're probably enjoying my content. So if you'd like to see more of my videos, hit that subscribe button so that you'll never miss my next financial insight. So if you read the headlines, things are getting better, but why don't they feel better? Well, even when inflation slows, prices don't automatically just go back down. You're still paying more for food, more for insurance, more for utilities, etc. So even if inflation drops from, say, 8% to 3%, your lifestyle doesn't automatically reset, right? Your expenses just are growing, but slower. And that gap between income growth and the cost of living is what people are really feeling. It's not a level of panic, it's just a large amount of pressure, and pressure changes behavior. Consumers spend less, businesses hire less, investors take fewer risk, and that's why fringe investments like Bitcoin and stocks, they feel correlated right now because the money is not flowing through them like it used to. So the next question is, will things turn around? And the short answer is yes. But you have to understand that markets don't turn around just because of a timeline or just because we're all hoping that it all turns around and gets better, right? They turn around because conditions change.
Yes, go on.
So, what conditions could cause a turnaround? I'm glad you asked. Here are 4 events that could cause a rebound. Number 1 is rate cuts. So, if inflation slows down, the Federal Reserve can lower interest rates. Lower rates means cheaper borrowing. And when borrowing is cheaper, businesses expand, people spend more, investors take more risk. And when the money starts moving around again, markets usually respond positively. Number 2 is quantitative easing, which is a big fancy word for printing money. And we all should be familiar with this because we saw this in 2020 in the COVID era. So if the economy slows down too much, the government steps in and adds this money into the system. And they do this by buying assets and injecting cash into the banks, and that increases the money supply. So more money in the system usually means that stocks rise, crypto rise, asset prices inflate. And we saw all of that in years like 2021, 2022, things just skyrocketed. Number 3 is earnings recovery. So stock prices are based on future profits. And if companies start reporting better profits than expected, investors gain confidence, and confidence leads to buying, and buying pushes prices higher. And a 4th thing that could cause a rebound is a new narrative. And a narrative is just a story for people to believe in. AI expansion, institutional crypto adoption, ETF inflows. And when people believe in something big, they invest early, and that builds momentum. More people start to jump in, and that momentum pulls in even more money. So the economy is recovering, even though it doesn't feel like it. And conditional changes like new narratives or lower interest rates are needed to fuel the turnaround. But in the meantime, what should we all be doing right now? And this is the part that really matters. First is build liquidity, right? Cash reserves are underrated in tight cycles. So things like high yield savings, short term instruments, and a stack of emergency funds is really helpful during this time. It makes things feel a lot better. Second thing is dollar cost averaging into things that you believe in, right? So if you believe in, for example, crypto long term, this is a great time to accumulate. And this is actually why crypto is a big part of my personal economy, because I believe in crypto, I believe in Bitcoin. And if you want to start building positions responsibly, I personally use Gemini and Kraken. They're beginner friendly, they're regulated, and they offer some of the highest sign up bonuses that I've seen. And if you use my referral link in the description of this video, deposit at least $100 on each platform, trade it for crypto, excluding stablecoins, you'll get $65 in bonuses. Or if you've been in the crypto game for a while and you know what you're doing, you might want to try Kraken Pro. They have lower fees and you can get up to $150 in bonuses when you sign up and trade with my link. So make sure you check that out.
I got you, homie.
Third thing you can do right now is reduce high interest debt. In a tight money environment, 24%, 27%. I've seen stuff as high as 30%. Credit card interest is just a guaranteed loss, and it is an albatross around your neck, especially in this type of economy. You have to get rid of that debt. And the fourth thing is focus on income stability, right? Cash flow. In this phase of the cycle, your job, your skills, that cash flow matters more than speculation. So are things going to be bad forever? No, right? Let's not get crazy emotional. Just understand that we are in a tightening phase, and tightening phases feel uncomfortable. It's not going to feel good. But in order for there to be a recalibration, the conditions of money have to change. And if you understand the cycle, then you won't be panicking when it happens. Remember, there's an emotional component to money, and that's something that we address on this channel. And when the economy slows down, people don't know what's happening and they fear the worst. They panic. But if you understand what's going on, you'll recognize that slowdowns are when structure is actually built, right? And if you're not building something right now, this is the prime time. If you're not building that, you're missing it. I am building business structure right now. I'm building investment structure right now so that when things do rebound, I'll be ready to take advantage of everything that's happening. And if this video helped you reframe what's happening in the economy as well, then click that share button. Share this with at least 2 people that are feeling the economic pressure. Show them what's going on and how they can be part of the rebound. Thanks again for watching, and I'll see you on the next one.